A trader made 47 winning trades in a row, then lost everything plus his house in the next 12 trades. Not because his strategy stopped working, but because his confidence grew faster than his account balance. If you think you're immune to overconfidence, you're already infected. There's only one thing more dangerous than not knowing what you're doing in the markets, and that's thinking you know more than you actually do. Let me ask you this. What's more dangerous to your trading account? Entering a trade at the wrong price, or entering a trade you shouldn't take at all because you're convinced you see something no one else sees? Bad entries cost you a few pips or points. Overconfidence costs you your entire account. Here's what overconfidence looks like in real time. A trader has 3 winning trades. Good executions, followed the system, made money. Then something shifts. They start thinking they have a feel for the market. They see a setup that doesn't quite meet their criteria, but they take it anyway because they're on a hot streak. They're no longer trading their system. They're trading their ego. It wins. Now it's confirmed. They really do have some special insight. The position sizes start creeping up. The stop losses get wider because they need room to be right. The trades that don't meet criteria start outnumbering the ones that do. And then the market does what it always does to overconfident traders. It humbles them. Violently. Completely. Permanently. Think about this. Casinos don't ban card counters because they're winning. They ban them because they have a proven edge and the discipline to execute it. But casinos love overconfident gamblers. The guy who just won big and thinks he's figured out the system. The person who's on a hot streak and increases their bets because they feel lucky. That person is about to give everything back, plus interest. And the casino knows it. In trading, there is no pit boss to ban you when you get overconfident. The market lets you keep trading. It lets you increase your size. It lets you break your rules. It lets you believe you've unlocked some secret. And then it takes everything. What overconfidence actually is. Let's be clear about what we're talking about. Overconfidence isn't feeling good after a winning trade. It's not being happy about a profitable week. It's not confidence in a tested system. Real overconfidence is when you start believing your recent success is because of your superior skill rather than proper execution of a probabilistic system. It's when you start thinking the normal rules don't apply to you. It's when you stop preparing because you think you already know what's going to happen. It's when you increase your risk because you're certain this trade will work. Overconfidence is the gap between your perceived skill and your actual skill. And in trading, that gap will cost you exactly as much money as it takes to close it. The Victor Niederhofer story. Let me tell you about one of the most brilliant traders who ever lived, and how overconfidence destroyed him. Twice. Victor Niederhofer was a legend. PhD from the University of Chicago. Ranked squash player. Protégé of George Soros. He ran his own hedge fund with spectacular returns. In the 1,990 seconds, his fund was consistently returning 30% or more annually. He wrote a best-selling book about markets. He was invited to speak at the most prestigious financial conferences. He was brilliant, educated, experienced, successful. And he was so overconfident that he blew up his fund. Not once, but twice. The first blow-up, October 1997. Niederhofer had developed a strategy selling out of the money put options on the S&P 500, essentially betting that the market wouldn't fall dramatically. For years, this strategy printed money. He collected premiums month after month. His confidence grew. His position sizes grew. His leverage grew. Then in October 1997, the Asian financial crisis triggered a massive market sell-off. The S&P 500 dropped 7% in a single day. Niederhofer's puts that were supposed to expire worthless were suddenly deep in the money. He faced margin calls he couldn't meet. In one day, his fund lost everything. $130 million gone. Not because he didn't understand options. Not because he couldn't do the math. But because he was so confident in his strategy that he ignored basic risk management. He had become certain that extreme market moves wouldn't happen. His confidence told him he could use massive leverage because he understood the market better than others. He was wrong. But here's where it gets interesting. Most traders would learn from this. Most traders would become more cautious, more risk-aware. Not Niederhofer. The second blow-up, 2007. After rebuilding, Niederhofer was back. New fund. Same brilliance. Same strategies. Same confidence. And in 2007, it happened again. This time he was selling volatility, betting that market swings would remain calm. He was using enormous leverage, controlling positions many times larger than his capital. When the subprime mortgage crisis hit and volatility exploded, his fund imploded. Again, another complete wipeout. A brilliant man. Decades of experience. A PhD in economics. Access to every piece of market data available. And he destroyed two separate fortunes because he could not overcome his own overconfidence. If Victor Niederhofer, with all his intelligence and experience, couldn't survive his own ego, what makes you think you can? The anatomy of an overconfident trader. Let me walk you through exactly how overconfidence destroys a trading account. Because it follows a predictable pattern every single time. Stage 1. Initial success. You have some winning trades. Maybe you followed your system perfectly. Maybe you got lucky. Doesn't matter. You made money. Your confidence increases. This is natural and not dangerous yet. Stage 2. Attribution error. This is where the poison enters. You start attributing your success to your skill, insight, or intelligence rather than to proper execution of a probabilistic system. You start thinking I'm good at this rather than my system works when I follow it. You begin to feel like you can see what others can't. Stage 3. Rule relaxation. Now you start making exceptions. A setup doesn't quite meet all your criteria, but you take it anyway because you have a strong feeling. Your stop loss should be here, but you place it further away to give yourself room to be right. Your system says 1% risk per trade, but this one is so obvious you risk 3%. Each exception feels justified in the moment. And when these trades win, it reinforces the behavior. Stage 4. Size increase. You start trading larger positions. Not because your account grew, not because your system says to, but because you're winning and you want to win more, faster. You convince yourself you're being aggressive, not reckless. You tell yourself you're taking advantage of your hot streak. You're actually just gambling with bigger chips. Stage 5. Feedback loop. Now you're in the danger zone. Your increasing confidence leads to looser rules. Looser rules lead to more trades taken outside your system. More trades outside your system mean you're relying on luck rather than edge. And luck eventually runs out. Stage 6. The reckoning. The market moves against you. Maybe a high-conviction trade fails. Maybe several trades in a row lose. But now you have a problem. You're in larger positions than your risk management allows. Your stops are too wide. Your account can't handle the normal losing streak your system expects. This is when traders either blow up completely or take catastrophic losses that set them back months or years. And here's the cruelest part. The trader often learns nothing from this. They blame the market. They blame bad luck. They blame external factors. They rarely recognize that their overconfidence murdered their account. So they rebuild, and 6 months later, they're right back at stage 2. The subtle forms of overconfidence. Most traders think they're not overconfident because they're not taking wild gambles or massively overleveraging. But overconfidence comes in subtle forms that are just as deadly. Form 1. Prediction addiction. You start trying to predict what the market will do next instead of reacting to what it's doing now. You find yourself saying things like, I think the market is going to, or this should happen next. Your system doesn't care what you think should happen. It only cares about executing when conditions are met. The moment you start predicting, you're overconfident. Form 2. Cherry-picking setups. You see 3 setups that meet your criteria, but you only take the one you like best. You're now trusting your discretion over your system. You're saying, I know better than my tested edge which trades will work. This is overconfidence dressed up as selectivity. Form 3. Refusing to take losses. Your stop gets hit, but you don't exit because you're sure the trade will come back. You know what's going to happen next. Except you don't. No one does. Refusing to take a loss isn't determination. It's overconfidence that your judgment is more reliable than your predetermined risk management. Form 4. Overanalyzing. You've made your trading decision, but you keep analyzing. Looking at more time frames. Checking more indicators. Seeking confirmation. Why? Because you're no longer trusting your system. You're trying to increase your certainty before entering. But certainty doesn't exist in trading. You have probability and you have edge. When you demand certainty, you're overconfident in your ability to know rather than humble in your ability to execute. Form 5. Trading during drawdowns. Your system is in a drawdown. This is normal. Every system has losing periods. But you're convinced you can trade your way out of it. You start taking more setups. You start forcing trades. You increase size to make the money back faster. This is overconfidence. The humble trader knows that drawdowns end by continuing to execute the system, not by trying harder. The confidence paradox. Here's what makes this so difficult. You need confidence to trade. You need to be confident enough to pull the trigger when your system says enter. You need to be confident enough to hold through normal volatility. You need to be confident enough to take the next trade after a loss. But there's a razor-thin line between functional confidence and destructive overconfidence. Functional confidence says my system has an edge, and if I execute it properly over many trades, I'll be profitable. Overconfidence says I have special insight that allows me to know what will happen next. Functional confidence is faith in your process. Overconfidence is faith in your predictions. Functional confidence lets you execute without fear. Overconfidence lets you execute without respect for risk. So how do you stay on the right side of this line? You focus on execution, never prediction. You measure yourself by rule following, not by profit and loss. You treat every trade as one in a series of thousands, not as a special situation. You remind yourself constantly that you do not and cannot know what will happen next. The cure for overconfidence. So how do you protect yourself from this account killer? Because you can't just try harder not to be overconfident. Your brain doesn't work that way. You need structural defenses. Defense 1. Track your confidence level. After every trade, rate your confidence level on that trade from 1 to 10. Then track whether high-confidence trades perform better than low-confidence trades. For most traders, you'll discover something disturbing. Your highest confidence trades often perform worse than your average trades. Why? Because high confidence led you to break rules. Bigger size, wider stops, looser criteria. When you see this data, when you prove to yourself that your confidence is inversely correlated with your results, it becomes harder to trust that confidence. Defense 2. Eliminate discretion. The more discretion you allow in your trading, the more room overconfidence has to operate. Your entry rules should be objective enough that 3 traders using your system would all take the same trades. If you're using judgment calls, you're inviting your ego to the table. And your ego will eventually convince you to break your rules. Defense 3. Maintain perspective through journaling. After every trade, write down not just what happened, but how certain you felt. When you review your journal, you'll see the pattern. The trades where you were absolutely certain, where you knew it would work, those are often your worst trades. The trades where you simply executed because your system said to, without emotional attachment, those tend to be your best. This pattern recognition is your defense. When you feel that certainty creeping in, you'll recognize it as the warning sign it is. Defense 4. Embrace uncertainty as a feature. Most traders try to eliminate uncertainty. They want to be sure before they trade. But uncertainty is not a bug in trading. It's the fundamental feature. Every single trade is uncertain. You never know if this one will win or lose. The moment you think you do know, you're overconfident. Train yourself to be comfortable with I don't know what will happen on this specific trade. They know they don't know. And that knowledge protects them from the overconfidence that kills everyone else. Let's bring this full circle. Victor Niederhofer was one of the most brilliant financial minds of his generation. PhD economist. Soros protege. Decades of experience. He destroyed 2 separate fortunes because he couldn't control his overconfidence. If he couldn't survive his own ego, you won't either unless you build structural defenses against it. Here's the truth most traders won't accept. You are not special. You do not have unique insight into market movements. You cannot predict what will happen next with any certainty. Your recent winning streak does not mean you've figured something out. And the moment you believe any of these things, you're already dying. You just don't know it yet. Overconfidence kills faster than bad entries. Because bad entries cost you your risk on one trade. Overconfidence costs you your entire account because it causes you to break every rule that would protect you. The solution is not to try harder to be humble. The solution is to build a system that removes your ego from the equation entirely. Objective rules. Automated risk management. Mandatory checklists. Zero discretion. This isn't about trusting yourself less. It's about trusting your process more. Your job is not to be smart. Your job is not to predict. Your job is not to know. Your job is to execute your system without interference from your ego. So ask yourself, are you executing a system or are you trading your confidence? Because only one of those survives long term.